Hello, everyone, and welcome to American Market Intelligence webinar on the very topical theme of China versus USA, the battle for Latin American trade and logistics. This will be the first of a series of webinars and also articles that we'll be publishing in the coming months in what we believe is the new paradigm of the global order and a paradigm in which Latin America is very much front and center. And we're very excited to explore this also in partnership with JAS, and we have with us Vivian Brunialti, originally from Brazil, who is the regional trade lane manager. And I'm also joined by my colleague, the head of our logistics and industry practice, Diego Rodríguez. Before I ask them to tell you a little bit about themselves, I want to just share with you a little bit about our company, America's Market Intelligence. We're supported by Valentina Duque in the background, who's helping us technically with this. Just very quickly, I think many of you know who we are. We are not a professional webinar company. That is just simply a marketing vehicle for us. We're in the business of helping our clients either grow, protect, or measure their businesses in Latin America. In this particular time, when people are concerned with external risks, this is really a time for protecting their business. But as Diego and Vivian will point out, there's plenty of opportunities to be found in this period of disruption. So there's also the opportunity to grow in select areas for almost any business imaginable working in Latin America. And when it comes to a period of disruption, it's often very useful to companies to be able to measure where they are, whether that yardstick is market share or their customer satisfaction, or just understanding their practices versus the best practices of the competition. So with that, let's move forward. I'd like to ask Vivian first to tell us, Vivian, a little bit about JAS and your role. And again, welcome to today's panel.
Thank you. Thank you for the invitation to be in this panel, John. It's really surprised me this week that we have been working together. I hope this is the first and much more to come. So I'm Vivian Brunialti, Brazilian, based in Miami almost 2 years. I have over 20 years experience. It's better to say now over 20 years to don't get a lot of details and show my age. But over 20 years experience across the technology industry. So I have worked in the industrial side and as well in the freight forwarder side. I'm in just 4 years as a regional director and focus on the Asia Pacific development. JAS is a multinational company, over 7,000 employees worldwide. We are present, in all of the countries, the main ones, especially here in Americas, with a high percentage in the automotive and tech sector. It was an Italian company, and we moved to Atlanta, so now we are American company. So our headquarters is in Atlanta. Besides of this, JAS, my official role, I'm also involved in a lot of women in logistics initiatives to promote and support the female leadership in our industry. And the most important thing, I'm mom of 2 boys. So that's it from my side. Transfer to you.
Thank you, Vivian. And Diego, please tell us about the AMI logistics practice and your role there.
Thank you, John. I'm really pleased to be here this afternoon. So I'm really eager to learn, not just to share knowledge, but also to learn from the participants about a very enriching discussion. So the logistics and industrial practice, I have been the leader of this practice in AMI for the past, I would say 8 years, but involved in market intelligence in Latin America since 2010. So I had the pleasure of doing research in more than 25 countries, if we include the islands of the Caribbean, out of the 38 nations in Latin America. And basically, my clients are logistics service providers or industrial companies involved in the B2B. And as you pointed out, John, I help organizations identify market opportunities, what are the top competitors or top partners in the different markets, but also understanding what are the trends and how those trends impact their business and impact the different market opportunities that they may find. So I'm regularly invited to participate in regional conferences, and I'm really excited to be here just to share some of the knowledge of the conversations that I'm regularly having with service providers, as Vivian, for instance, or with customers shipping or exporting into Latin America. So thank you for the invitation, John.
Great. No, thank you, Diego. And just as a sort of housekeeping note for everyone, at the bottom of your screen, you should find a Q&A icon. And if you click on that, you can post any question you like, and we will address your questions towards the end of the webinar. We have officially put aside an hour, but for those of you whose questions are not answered completely at the end of the hour, or those of you who want to continue to listen in to the answers, we will continue to answer those questions past the 1:30 Eastern time or 1 hour from now time slot. So just keep that in mind. You should also know, if you registered, and clearly if you're on the call listening, you did register, then you will be receiving automatically a recording of this webinar, as well as the PowerPoint deck that we are going to be walking through. So with that in mind, let's move forward to the next slide. We'd like to begin by asking you to tell us your thoughts on how U.S. trade policy changes are impacting your business. There's a number of options here, and we'd like you to choose anywhere from 1 to 3 responses that you feel are most closely capture the impact of changing trade policy on your business. So the first is, we're cutting internal costs, or negotiating lower supplier costs, and or implementing a hiring freeze. The second is, we are increasing our prices. The third is, we are lowering our prices. The fourth is, we are sourcing more from Latin American suppliers, including Mexico. The fifth is, we are trying to sell more into Latin America to compensate for fewer sales to the United States. Sixth is, we shortened our planning time frame from annual to quarterly or semi-annual because of the uncertainty. And seventh, we are stocking more inventory in bonded warehouses or offshore, waiting for reduction in tariffs. And lastly, we are closely monitoring the competition to see how they react to tariff changes. So hopefully that's given you a little bit of time to respond. And not sure how we're doing, Valentino, with responses, but if we've got, say, at least 60 responses, let's go ahead and publish the results of that. Okay, interesting. So people are definitely in either a cost-cutting mode and or price increasing mode. So companies are clearly cognizant of shrinking margins and trying to maintain those margins. Very interesting that there's quite a bit more sourcing going on from Latin America, as well as looking to Latin America to enhance sales. So those are all interesting results. We also see a big emphasis on watching the competition. 46% of you are keeping a close eye on your competitors. I imagine you're looking at their pricing, if not as well, how they're going to market or changing that. So terrific. Really appreciate your responses there. And let's move forward. So very quickly, again, this is the first of what we hope will be a series of webinars around this geopolitical rivalry between the United States and China, as it pertains to Latin American and Caribbean markets. And so I want to quickly review, for most of you this is academic, but I want to quickly review how Chinese engagement in Latin America has evolved over the last quarter century. Let's move to the next slide. So there's really been 4 waves of foreign direct investment. The first and most strategic was to acquire natural resource assets. Unlike the Japanese and Koreans who went through the same challenge in the past to guarantee access to natural resources as they ramped up their industrial sector, by the time China got around to this, the cost of natural resources was very high. And so they chose to buy assets as opposed to buying into long-term service contracts. And so you saw a lot of investment in mining companies, in energy companies, in agricultural companies. And then China, in a response to the financial crises of 2007, 2008, China was very impacted by that, by the lack of trade finance. And so its export economy was very much at risk and suffered for a year. And so China began a sort of Keynesian spending spree to keep people employed. And a lot of that was focused on infrastructure, things like metro systems, roadways, railways, public housing. And as a result, from 2007 to about 2012, China developed the largest engineering industry in the world by far. Millions were employed. But by 2012, 2013, China's municipal debt levels were through the roof. China has some of the highest debt levels in the world on as a percentage of the GDP. And so they needed to keep these people in the construction sector employed, but they didn't have capacity in China. So they began the Belt and Road Initiative, which is really designed to keep Chinese companies employed now in international markets. And in doing so, of course, better engage China with the rest of the world and begin a diplomatic push into many neighboring markets, including markets as far away as Latin America and Africa. Eventually, China evolved from a maquiladora economy to an economy with its own brands and its own unique products, including 50 car companies and over 100 car brands that today look for markets abroad. And those markets are disproportionately middle-income markets like Latin America, like Turkey, like Eastern Europe, et cetera. And so that's where China's focused its marketing efforts and opening market access with its branded products. And the most recent wave is mostly driven by private Chinese companies in the digital economy. Of the 10 largest e-commerce platforms in Brazil, for example, 6 are owned by Chinese companies. Let's move to the next slide. When it comes to trade, China and Latin America are very complementary economies, much more so than Latin America and the United States. The US competes with agricultural interests in places like Brazil and Argentina. It competes with aerospace interests in places like Brazil. But with China, there's a lot less competition between Latin America and China. And as a result, two-way trade between those two continents is growing faster than two-way trade between the US and Latin America. Okay, let's move on. Now, why is the rhetoric out of Washington so explicitly anti-China these days? Well, this is actually not something that was just brought to light since the latest election in the US. It's been slowly but surely brewing. If you think about foreign policy in the United States, it's really built on 3 pillars. One pillar is political, whereby the political class is really informed by think tanks. And think tanks, whether they work for the Republicans or whether they work for the Democrats, have been sounding alarms about China's growing strength around the world for quite some time. At the same time, the US Armed Services, the Department of Defense, has also been very concerned and is in fact being in sort of low-grade cyber war with China for now more than 15 years. The one pillar that has held out, that has not wanted to antagonize China, is the US corporate sector. And on the next slide, you'll see that the US corporate sector, the automotive sector, the high-tech sector, the infrastructure and engineering sector, the finance sector, have all tried to penetrate successfully the Chinese market, and they've all failed, along with energy companies. And so at the same time, in all of these sectors, they've begun to lose market share in markets like Latin America. I mentioned the rise of Chinese e-commerce in Brazil as an example. The other is that the US relied on China as a cheap place to outsource its manufacturing. Well, Chinese labor is no longer cheap because the Chinese population under the 50 years of age has been shrinking since 2008. So the cost of recruiting people into Chinese factories keeps growing at about 10% a year. So regardless of US tariffs on Chinese goods, it doesn't make economic sense to outsource to China to then repatriate a product back to the United States. It's too costly. And so the corporate sector in the United States about 6 years ago came to the realization that China was more of a threat than an opportunity. And so it joined the political and military thinkers in Washington, and we began to see an anti-China stance under Trump's first administration. It was very much continued by Biden and is now continued by Trump's second administration. Let's move to the next. Now, the US would like its partners in Latin America to wean themselves off of Chinese investment, to wean themselves off of Chinese lending and of Chinese customers. The US has been fairly effective so far, although some would say it's more window dressing than reality, at getting Panama to disassociate itself somewhat from China. But it's going to be a lot tougher to convince Brazil, Argentina, Chile, or Peru, or Bolivia for that matter, to stop doing business with China. China is, as we'll see on the next slide, is a very big customer and source of finance and source of investment in the economies of Ecuador, Peru, Brazil, Argentina, and Chile. So the US does not have the same level of leverage over these countries to convince them versus the leverage they might have over Mexico or Panama or the DR or other countries in the northern half of Latin America. Let's move forward. We've yet to see exactly how the Chinese will react, but what we do know from quiet conversations that have been ongoing between governments in Latin America and China since the Trump administration began its tariff policies, is that the Chinese are more than happy to step in and fill the funding gap if the Americans do in fact retreat from international organizations, whether it's the UN, the IDB, the World Bank, PAHO, or any other organization that is in the business of fomenting development in these countries or fomenting the health system or providing aid and assistance. China will gladly step in to that role. They've been wanting a bigger part of these multilateral organizations now for 20 years, and this may be, in fact, the window that allows them to do that. We are also seeing the Chinese doubling down on its commitments to foreign direct investment, to bilateral lending, as well as we're seeing an increase, for instance, in the purchase of agricultural goods out of several countries, and Diego will go into that more intensely. But we're seeing this as an opportunity that China is not going to fail to exploit. As the US retreats, China will fill its place. So with that, let's move forward. And I'll pass it over to you, Vivian, to walk us through your interpretation of the air freight markets of Latin America.
Thank you, John. So let's talk now about the air freight market. You can go to the next slide. So let's start it here in the outlook. First, the demand. The demand is expected to increase, especially to the US recent tariff changes that we have this week. However, we need to monitor. If the US situation persists, especially for the minimis, there is a high possibility of e-commerce shifting to Latin America. Brazil, for example, is already seeing increase in prospection of new airports in the north of the country, like Recife, like Fortaleza, where these airports are adapting themselves to receive the e-commerce business, because this is not simple, or this is not like the normal import shipments. So they are preparing themselves to receive this, foreseeing some increase. Additionally, we have the Chinese manufacturers using Latin America as a market alternative. We have a huge growth in Brazil for the semiconductors business, especially. As demand and capacity are linked, we can see a slight increase in LatAm due to these USA diversions. So where the freighters could redeploy wide-body capacity in Trans-Pacific lanes to Asia, Latin America, as they seek to fill gaps. I'm talking here, of course, with the focus of Latin America, because we see this possibility, but it's also possible to put in another trade lanes as the huge one that is intra-Asia. Okay, but we also believe in the Asia, Latin America about this redeployment in capacity. Rates. When do we look the rates that we have in place now, comparing with the rates a year ago, the rates is now an average 15% higher. Okay, so even though with all of the situation that we are talking, so we expected the rates to remain in high levels. So even though with some possible changes in putting more capacity, we know that the capacity is going to be only in place if the airlines foresee demand. In the short mid-term, while Miami will certainly remain the major hub for Latin America, is also expected this extra volume in capacity, especially because for the e-commerce players into Latin America. And there is also possibility, what we already start to see, in bonded warehouses and free trade zone infrastructure across all the region, especially in Panama and Uruguay, with these main areas for the free trade zone. In the next slide, it's a provocative question. So, is the semiconductor, it's going to replace the e-commerce? And the answer is no, it's not in volume. Semiconductor won't replace e-commerce. It's impossible. In terms of cargo value, yes, but in terms of volume, no. If we look here in the asymmetry graphic, the strong trade growth in the semiconductors, so 20%, the biggest one that we have. This is driven by the demand from electronics, automotive, AI, and Internet of Things. So the expectative, as this serve a diverse of industry, the expectative is to grow even more. What is important? Supply is not just from China. It's also expanding across Taiwan, Korea, Malaysia, and Vietnam. And this is important also to highlight one situation where the US is investing a lot in the local, in the domestic production. So for sure, the Asia Pacific will expand and explore other markets to ship the semicon. So this is why it's a sub-industry that is growing, and we expect even more. The next slide complements this one as well. Where I said the commerce equation is not possible to be compensated. Considering the May Day holiday and the new minimis rules from May 2nd, around 46 freighters did not operate. It represents 4,000 tons per day, 10% of the global volume. In the other side, we could see increasing capacity from Europe to North America by 11%, and North America to South America because of the flower seasons for the Mother's Day. This is the shift that we have in the market, where the airlines is going to put their capacity, where they see demand. Of course, you know, during 3-4 days cancellations, freighters, it was a big impact in the market, but they are going to estimate all the market to put the freighters. So the key word here, when we think about this equation, is the key word is relocation, not compensation. Relocate capacity according the demand. In the next slide, it is possible to see the vulnerability of the US supply chain on China. It's, you know, this slide, this graphic really called my attention. So 7 of the top 10 import categories in Latin America, 7 of the top 10 categories in US depend on China. So it's over than 75%. While we are seeing some sourcing diversification to the other countries, how fast can these newer regions scale up? So developing quality, infrastructure, production capacity is not something that happens overnight from one day to the other. It's a long-term shift. So this situation, this diversifying too fast may occur in higher logistics costs, margin for the companies, delays in delivery, in availability, and at the end of the day, the result is going to be higher.
Well, Vivian returns. It's my turn to speak. So it's my turn to share some of the knowledge that we have gained so far. So let's talk about the anticipated changes in trade policy and how that connects with the information that Vivian has been sharing. So if we move on to the next slide, I would like to show you the importance of the tariffs and the strategic goals that the US is pursuing, especially Trump. And I'm sure everyone knows that the US is following 5 strategic goals, which is repatriating manufacturing jobs to the US, getting greater access to American companies in international markets. But the reality when we think about these strategic goals is that Trump loves chaos. He's very unpredictable. And the other day I was watching a very interesting documentary in the History Channel, which was The Men Who Built America. And Trump was one of the interviewees, and he was providing remarks about his thoughts about how the American economy became what it is today. And he says something really interesting, and I want you to remember this. And he said this 10 years ago before becoming president. He says, during times of crisis, aggressive and bold actions create fortunes. And that's what allowed Rockefeller, JP Morgan, Carnegie become billionaires. So when you think about what we're going through right now, perhaps these 5 reasons are just window dressing, as John is saying. He's just creating chaos because he has been backtracking many of his policies during the first quarter of this year. So there's a very low likelihood of getting successful when it comes to isolating China, for instance. John was describing how it is very difficult for Brazil, Argentina to choose sides, especially when we just got news from the recent meeting between Lula and President Xi Jinping, in which Brazil announced more than $5.7 billion in investments in Brazil, including semiconductors, including port infrastructure. Let's remember that there's a Chinese company actually building a new terminal in the port of Santos to increase export capacity of grains from 4.5 million tons to 14 million tons. So we're seeing these strategic reasons actually getting out of the window because the plan that the Trump administration has is just create chaos and negotiate short-term deals that he can sell to the US base. But when you look at the US UK trade deal, there's no substantial changes, especially when it comes to American beef companies getting greater access to the UK market. We didn't see many changes, so it's only window dressing. And what's really interesting in these policy changes is that if we go to the next slide, Trump actually got really spooked by the market reaction to his policies. So when you look at how the S&P 500 has performed over the first 100 days of his administration, it has been one of the worst for any president, but also very interesting to see the other situation, which is we have the bond market actually reacting very widely, and considering the hypothesis that the US is the safest haven for investment, he got spooked by the bond market. So he started to backtracking on his policies, but most importantly is the fact that inflation expectations are growing and we have a slower growth in the US economy. We just got the GDP numbers, we got a contraction, and tariffs will trickle down to consumer prices, and we will have greater chances of a recession in the US this year in the next 12 months. So if we compare that to November, where we had less than 10% chances, now we're in 45% by some analysts. So that spooked Trump. But again, let's keep into consideration that during times of crisis, there's opportunity to make fortunes. And if we look at Liberation Day stock market performance versus today, we have recovered all the losses in the stock market. And now we're not in a bear market any longer. So that gives you an idea of his behavior and the way that even though that we have tariffs one day, then the other day no, it's probably the norm for the next 6 months. So what companies need to do is actually adjust, find alternatives, and especially find new ways in which we can develop a strategy to deal with Trump and the uncertainty, because that is going to remain in the marketplace. So let's move on to the next one. And let's talk about USMCA, because it's very clear that the USMCA, it's not going to be dismantled. As of today, Canada has removed all retaliatory tariffs against US products. And Mexicans have been very smart, especially President Sheinbaum, in dealing with the tariff threat. So the reality is that even though that we expect to have the USMCA reapproved by 2026, I'm actually bold to say that we may get this deal approved and renewed before the end of the year, considering how things are going. And the reality is that we may get some slight changes, window dressing, as John says. We may get more access in the Mexican energy sector for American companies, or in the Canadian retail banking sector, more access for American companies. So we may see very strategic changes in the USMCA, but not substantial changes. That's the reality. So that's what we need to keep our eyes on, because at the end of the day, let's remember that Trump, probably 18 months ago, nobody thought he could be reelected, but he went through an assassination attempt. So my guess is that he believes that he's Superman. He can do anything, and that's part of his chaotic strategy in order to adjust or change the status quo. So let's move on to the next one. And let's talk about the changes in the trade flows, because this is really interesting. So if I complement the remark about this Chinese company making investments in Port of Santos to expand the capacity to export agricultural commodities like soybean and others, and there were announcements recently in this meeting between Lula and President Xi Jinping about building the railroad to connect the agricultural exports of Brazil through the Pacific in the port of Shanghai. It is clear that China is investing heavily in infrastructure. And when you look at the recent announcement as well of Colombia joining the Belt and Road Initiative, it is clear that China is looking into new markets to push their products as their sales in the US starts to dwindle down. And I will look at the numbers in the next slide, or perhaps in a couple of slides, in which we show how Chinese exports increased to Latin America in the month of April by 17%. That gives you an idea how China is pushing volumes through Latin America. And also we're seeing how there's increasing intra-regional trade within Latin America, because Panama is becoming again a hub for foreign trade zones, sourcing the Caribbean, sourcing Central America, and sourcing some of the Andean countries. The reason why, it's because those products can be safely stored in Panama. They don't pay duties, as opposed to what happens to those goods that flow to the US and are tariffed by 30%. So Panama is recovering that hub position in Latin America. And when we look at the Caribbean countries, there are also opportunities, and they're also shifting their sourcing. They're buying more from Mexico, they're buying more from Brazil, more from Colombia. Why? Because for them, there's a cash flow situation as well, in which they cannot go directly to the source, which is China, but they prefer to go with regional suppliers, in which they can have shorter lead times for their orders. And that basically is one of the things that companies consider with their cash flow. If I go to China directly, I need to wait 30, 45 days for my products to arrive. But if I go intra-regionally in Mexico, in Brazil, in Colombia, in Panama, my lead time is less than 2 weeks. So that plays into the equation. Now, last comment about the shift in trade flows. The EU and Mercosur are about to start their free trade agreement thanks to Trump, because the French agricultural sector, the Germans, and also the Hungarians who were the main opposition sections of this free trade agreement. Now they see an opportunity in finding new customers in Latin America. And anecdotally, this is an example, I have been getting lots of requests from European companies looking into Latin America as a potential market to sell their products as they look to diversify from the US. So that's how we are seeing those shifting patterns actually taking place as we speak. Let's move forward. And the floor is yours, Vivian.
Thank you. Apologize because it seemed that I had some internet issues, and you could not listen my last part of the slide. But now back to talk about the ocean portion. Let's go to the next slide, Vale. So when we look here, the demand for the ocean freight, it's stable to Latin America, except Mexico. Mexico has been impacted by the tax rule changed in November last year, and also related to the marketing uncertainty starting this year with the US government due to the nearshoring between Mexico and US. The peak season for the ocean shipments, especially for the retailers, that is the drive for this trade, it's expected from July to September to attend the year-end demand, and also the Black Friday in November. And it coincides partially with the 90-day tariff suspension window. So we already see an increase in demand this week, and we foresee that is going to continue increasing during this, especially during this time. So let's think here up to September. In the meantime, it's also important to say that the boom with the electrical vehicles that we had in 2024 continue growing, not in the same proportional that we had last year, but with a high growth this year. We are going to see detail more. Capacity. When we look to the capacity in Latin America, normally we split in two. So we have the West Coast, South America, stable after 25% increase year over year, and East Coast South America having more and more increase. One of the reasons, it's also linked with the EV cars, especially to Brazil that I just said. So East Coast South America had an increase in capacity in 6% in 2024. And in the Q2 now in 2025, more 15. So it's almost the double of capacity year over year. In the meantime, of course, we see shifting carriers, new alliances, direct services to Mexico. It was normal, but now we also have direct services to Chile, to Peru. And this is some very good in the trade because, especially to these countries, transit times it's improving. But with the new alliances, we can have a reduction in the flexibility as multi-carriers operating in the same vessel. Important to mention here that the US market with the tariff situation had a decrease in 40% of capacity. This 40% capacity was suspended. And imagine now this week with the 90 days tariff pause, it's starting new bookings, orders that were on hold being released. And additional, the fact that the companies run now to ship as much as possible during the 90 days window. So with this current capacity suspension, it's not going to be enough to cover the US market. It will force carriers to relocate space from other trade lanes. And a strong candidate for this relocation is Latin America. We are also start to see this week announcement in blank sailings that were not expected to cover the US market. New vessels expected to the second semester, but not sure the trade. When we look at the rates, we are going to continue with the volatility of the rates. This volatility of the rates is given the current capacity situation combined with the peak season that I just mentioned. And so we see possible increase after June on. Additionally, when containers accumulate, that is related to equipment imbalances, when containers accumulate in some locations and become scarce in others, equipment imbalances occur. Then can result in high rates driven by shortage, cost repositioning, limit booking flexibility, and all of this reduce availability and push prices upward. So basically, when we see short and mid-term, carriers will try to keep a health rate. When we say health rate, it's despite all the expectations that we have with Mexico reduction, with some low demand in the beginning of the year, the carriers kept the rates up to the 3 digits. So strategically using blank sailing to stabilize it, but they find a way to keep a health rate. With rising demand expected during the 90 days tariff pause and the retail season, we can see some anticipation port congestion and ongoing schedule and reliability to be key challenges for now on. The next slide, it's important to highlight that even though what I have just said, APEC Latin America is the second fastest growing global trade lane. It's only behind the Asia Pacific to Europe. so with 21%, and then Asia, Latin America, 18%. For the first time, Brazil has big share than Mexico, although both still represent more than 50% over the total volume. On the other side, it's possible to see economic growth visible on both ends. So Chinese investments in Latin America continue driving this momentum. So we have an example of the Chancay port in Peru, where the operations started latest November. It was basically Chinese capital. Brazil, we have the BRICS members, a lot of expansion in manufacturing. We can see BYD build up factories in Brazil. And recently, not sure if it's last week or this week, the Colombia announced the new trade agreement with China. So further signaling stronger growth potential ahead. Next slide, it's a little bit more the details for the EV evolution. As I mentioned in the first slide, this is a complement for that. This EV evolution in 2024 and keep strong this year, as we see. So one graphic is 2024, the other one is year-to-date February, the century date, shows vehicles as the biggest sub-industry in the trade. So 34% increase year over year. So what has increased is going to continue. The expansion of the EV market is redefining the supply chain, driven by customer demand, sustainability goals, and China strategic positioning in our region here. The growth, especially in Brazil, which benefit also the whole Latin America and especially the East Coast of America, and building up these factors that is supporting the growth of the country as well. In Chile, with a focus on clean energy and mining for battery materials like lithium, it's also emerging as a key player for that. The next slide is the dynamics of rates and capacity. This is something new that we have in Xeneta. Xeneta is a very good source to see the evolution, especially in the rates. So far was the rates, and now some specific traits started to show more than the rates, but it's showing the capacity, reliability, schedule, so we have more information on. So for the East Coast of America, we can see what I mentioned, the increase of capacity. When we see a strong increase in capacity, as we had that, as I mentioned, it was 85% increase year over year, we can also see when as much as capacity increase and the demand is still not there, the rates start to go down as well. So we have this fluctuation here for the East Coast of America. So we have now the rate level in the right section that we see it's in the average of $2,000, and then comparing with same period than last year, the rates were down 65%, so 65% lower. And in the next one is the West Coast of America. Unfortunately for this trade, we don't see the capacity, but in this trade, the trade, it's huge. It's a trade with more than 114,000 TEUs per week. So it's, let's say it's like 3 times the East Coast of America. It's a huge one. So Xeneta does not have until now the possibility to see the capacity, but we can see the rates. So, and it's the same situation. So as much as we have the capacity for this trade was the average of a 20% increase. As the demand is not there, especially because of Mexico. Mexico, it is the leader for West Coast of America, but we can see now much more portion with Chile and Peru. And as we have capacity is growing and the demand is still not there, we have this rate fluctuation. But as I said in a lot of slides, no, with all the changes we received so far, we are expecting, the rates on both air freight and also ocean freight increasing, especially from June on. So now I transfer back to Diego.
Thank you, Vivian. Let's wrap up the conversation because I see we have lots of questions. So, Vale, yeah, please move on. Next one. I just want to briefly touch upon this on the e-commerce situation because we did a really exciting exercise that we wanted to show you today. So, considering all the shifts in trade flow, especially on the e-commerce side, when we think about the US eliminating the de minimis exemption with Chinese products, everyone is talking about how Chinese companies will start to move to new markets. And we did this exercise to see and estimate how much they could grow in Latin America. So we did this really cool exercise trying to predict sales based on average ticket prices, average online conversions, and monthly website visits to these marketplaces in order to see what's the potential growth for Chinese e-commerce platforms like Temu, Shein, and AliExpress. And we came up with this analysis in which we expect e-commerce platforms from China increasing their sales by 47%, almost doubling their sales in 1 year in Latin America. And when we look at the potential market share of Chinese e-commerce platforms in the region, is closer to 13% if we consider that the online retail sales in Latin America are close to $100 billion in 2025. So that gives us an idea of how much volume Chinese companies will push to Latin America. And also we need to consider that, as Vivian said, Miami is a key hub to connect China with Latin America, but also let's think about the port of Shanghai as a potential hub to receive these products by ocean, consolidate them, and then distribute them intra-regionally from Peru, Brazil, Peru, Chile, Peru, Colombia, Peru, Ecuador. Because when we think about air freight flows, we need to also consider the de minimis rules in Latin America, and they're very strict. In the case of Brazil, the de minimis is for products less than $50, but they also are taxed. So Chile, very low amount, less than $25. In some, I think it was eliminated last year. And then we have Colombia with the exception only for the US products, not with China. So how can China penetrate these markets? Again, pricing, but also utilizing their model that it has been really successful. So what they do in China is basically for Southeast Asia, they have these hubs in which products are stored, and from there they're distributed to other markets in Southeast Asia. So that's what we expect to see in South America with this port of Shanghai, as we get very quick transit times, less than 25 days, 20 days in some cases. So that's something to keep into consideration with the e-commerce change, how we might get some volumes into the ocean market, replacing some of the air floats. And let's talk about the last slide before we go to the Q&A. Next one. I briefly touch upon that one. So this one is the one that I want to focus. We are seeing increased congestion in Caribbean ports, key ports in the region like Caucedo, Kingston, Cartagena, and Freeport. For instance, Kingston, when you compare transshipment volumes between April 2025 and April 2024, increased by 50%. And this is based on shipping lines just finding a space to put some of their containers, and the dwell time that we're seeing in some of these ports has increased. So in Kingston, we have 10 days of transshipment dwell time. And in Cartagena, we have more than 34 days of transshipment. So that gives us an idea how companies are just looking for a space. And let's be honest, we have in the region physical and geographical constraints, especially in the ports in the Caribbean. Caucedo, Kingston, we have very limited space. And just recently, DP World announced investments to expand the free trade zone in Caucedo. So that gives us an idea how these countries and these ports are trying to place themselves strategically to receive some of those additional volumes that are not passing through the US. So we might see some of that shift in the trade volumes as well in the ocean market. And let's move on to the next one. I think this was the last slide. This is something that everyone knows. I don't want to spend time on this. The 90-day pause and the impact, as Vivian said. We expect to see a rebound in import volumes from China, so we might get more inventory in the US. We are starting to get more demand for warehouse space, especially bonded warehouse and foreign trade zones. So those are some of the opportunities in which Latin American countries can actually play in these global trade shifts that we're seeing right now. So back to you, John, so we can have some time for the Q&A.
Thanks, Diego. Valentina, if you could take us to the last slide. I just want to make sure that people have access to the QR code there, which enables you to access our library of articles, other webinars, white papers, etc. We got a number of questions from the audience, some of them very, very technical and very particular, so that's great. That shows a real bona fide interest in this topic from people who are in this business of logistics. From Guatemala and Colombia, we have a question, and that is, given this 90-day honeymoon, and that could apply both to the tariff reduction with China as well as the tariff reduction with other countries around the world, which both have been set with a time clock of 90 days on them, will we see a massive increase in FCL and AFR shipments into the US that would subsequently increase rates and presumably push up rates into Latin America as well? Is that something that you anticipate, Vivian, Diego?
Yeah, let me take a first stab at this one. I think it's gonna be an increase in rates, definitely, because what we are seeing is actually some of those volumes that were coming out of China, they dropped by 21% to the US, but they increased to Southeast Asia by the same 21% in April. So that gives you an idea that companies in the US are not stopping their purchases in Asia, but they're moving their flows to other markets, and their Chinese sellers are also moving products and raw materials to Southeast Asia in order to sell to the US. And that's real, that's happening. And with this 90-day pause, what we expect to see is, again, companies increasing their inventory, and the 40% drop in capacity that Vivian mentioned will actually probably we will see some carriers reallocating vessels in a quick manner based on the recent remarks by Maersk global CEO. It takes less than 1 week to reposition some of those vessels that were in blank sailing. So capacity will come back to this lane, and with capacity, additional capacity, we may see some increases in rates, but the reality is that we may see a short but very spicy peak season, which will push up some of the rates as well for Latin America. I'm not sure, what are your thoughts, Vivian?
Yeah, I agree. I also want to complement that for the USA market, the rates already started to increase a lot. Very high DRI levels already received this week because of this capacity that was cut. And capacity that was into Latin America, for sure, will be reallocated to support the US lane. So when we allocated also capacity from Latin America to support the US lane, our rates here in our side are going to increase. And then also with the situation that we have, this is in the ocean freight side, in the situation that we have, the peak season for the retailers. So we believe the rates is going to be increased from June on. Okay, so this is the expectative. So for both, the US, it's going to be very strong. Levels of DRI that we are already receiving, $4,000 to USA. So for sure, this is going to push volumes from other trades, and especially ours. And in air freight, we are going to have the same situation. So these 90 days, the company is going to try, in USA is going to try to bring as much as they can. And then we need to monitor after these 90 days, what is going to be the market. So it's really challenging to say if after these 90 days, the rate is going to be high or in a low level. I don't believe, as all the analysis and everything that we just show, that the rates is going to drop, maybe stabilize, but not drop. And with this period, that is going to be high.
Perfect, makes sense. I saw, Vivian, that you were going. It looks like you were typing a response to Rafael Quintana's question. Don't know if you want to continue doing that.
Yes.
Or if you want to respond to it.
Yeah, I go ahead. So the question from Rafael is, how will be the availability of containers and shipping lanes to Brazil, considering these 90 days truce between USA, China? So Rafael, the container availability is going to be a challenge. So in the time that we had all of this capacity suspended to US, when do we accumulate containers in one side and reduce to another side? For sure, we are going to have a shortage containers in China, especially the 20 food containers. And this short container shortage is going to impact US and Latin America and also the other trade lanes. So for sure, it's going to be impacted, and it can also result in high costs, in premium rates. So we needed to monitor and foresee how it's going to be. And shipping lanes to Brazil. So for now, as I informed, when we see the basic ports China to East Coast of America, we have a strong increase in the capacity, more or less the double than last year. If we need to reallocate, we know if the carriers need to reallocate through blank sailings, so it's going to be, also a peak rate, premium rate to our market in Latin America and in Brazil. So it's going to be according to, and the carrier, they reallocate the vessels according to the demand. So if the US in these 90 days is going to be the highest payer, for sure they are going to reallocate this. But we have this increasing capacity to Brazil, and for sure we are going to continue to have this capacity with possible reductions, but the capacity is there.
Perfect, thank you. We have a question related to European companies that we mentioned that there's a lot of interest, and that's true, at looking at Latin America as a market by European, particularly middle-sized industrial companies that feel that they may not be able to sell as much into the United States, so they're looking for alternative markets. How do you see this opportunity in the market if Brazil does not change its tariff and taxation policies as a pretty protectionist market? And are there any other countries in Latin America? If I could just, I'll start by answering that, and then Diego, if you want to add to it. First of all, I think that what we're seeing, both Diego and I are receiving, are questions and requests for research. So these companies have not yet determined how much they can sell into these markets. They've not yet determined really whether their products are going to be able to compete in these markets. They haven't determined whether their brand has any recognition or obvious accessible clients. That's really what we help them do. We're helping them to identify, can they compete in this market? What would it take to raise their profile and be trusted by buyers, particularly on the B2B side? That takes time. Now, if you're a manufacturer and you've got lines of production and you're used to putting X thousands of numbers of units into the US market, and suddenly that's less viable, your first reaction is not necessarily to lay off people or slow down production, but to look for alternative markets. And that's really where they are. We will see, and I think the question points to the reality that it's not necessarily easy to replace those US customers with customers in Latin America. But they're certainly trying. And that's what we've been fielding. I don't know if Diego, you want to take it from there.
Definitely. Part of the request that we're getting is actually identifying potential distributors, potential buyers, understand where they can compete, because pricing is a key concern for them, not only because Chinese products are really competitive, but also because they have a very strong hold in South America. So based upon what you have describing, John, in the past, Chinese brands are everywhere in Latin America, from cars, cell phones, industrial goods. And even though that European industrial products are considered higher quality, they come with a higher price tag. And that's where it becomes difficult. So in the case of Brazil, Chile, Colombia, Argentina, there are opportunities that need to be explored. But the problem right now is the uncertainty in which European companies are looking for these new markets, but they are not 100% committed because of the price tag. So that's where we are right now. Even though there are opportunities, challenges remain on the prices as well.
Yeah, I think for a lot of these companies, it's the first time taking a serious look at markets like Brazil and Argentina and Mexico. Vivian, have you observed, as a freight forwarder, have you observed any challenges or cost changes and increases associated with the ownership of cargo ships? I don't know if you guys actually own your cargo ships or if you're subcontracting those, but.
Yeah, in fact, we subcontractor, so we have the ocean carriers to move the ocean freight, and the airlines for the air freight. But in the airline side, we also have a charter in the market. So it's when you have a charter in the market, you have like you rent this space, so it's you are not the owner of the airplane, but it's a rental. So when do we have charter in from Europe to US, and we have charter from Hong Kong that covers all the South China to all Latin America via Miami. So the charter is to Miami, and then from Miami we can cover the whole Latin America. We are not the owner, as I just said, but we are renting this space. So it's a kind of, it's regular things, it's twice per week, and it's a reliable service, so it's like we are the airline at the end of the day.
Perfect. I have an interesting question. I take it from our discussion today that there's really, right now, there's two significant regional hubs, Miami for air freight into Latin America and Panama for ocean. Do you foresee any additional hubs emerging? We've been talking a little bit about Shanghai, but I understand the capacity and the operations are not, are not nearly at the potential they might serve eventually. But what's your sense in terms of what additional hubs we might see emerge over the next 5 years for either of you?
So let me start, Vivian, let me start with that one. With the port of Shanghai, based on my conversations, the situation is we have a sailing right now between China and port of Shanghai. Even though that the port was inaugurated back in November, the reality is that only until 2 weeks ago or 3 weeks ago, we had the first sailing. So the next 6 months is get the operation up and running, but that's definitely a potential hub in the next 12 months. So during the rest of this year, we may see the operation just fine-tuning, getting the machinery greased, as we say, but Shanghai has all the potential to become this hub to distribute those retail goods coming from China by ocean. Now, when it comes to Panama, foreign trade zones are booming, especially because when you look at the costs of bonded warehouses in the US, they are sky high compared to other places in Latin America. So Panama is one of them. Again, I think the Dominican Republic is doing a great job when it comes to infrastructure ease of doing business, and it has a great partner, DP World, developing that port. So they just announced investments to expand the foreign trade zone. Now, I just participated yesterday in a webinar by the new port of Antioquia, which is this port in Turbo, Colombia. And what we got from that webinar is that amazing location in order to facilitate domestic transportation within Colombia for export, imports for perishables, especially. So bananas, avocados, citrus, etc. But that's going to become a new port to serve Colombia, but also shipments to Central America, the US, and Europe. Very interesting. And lastly, I think this is the opportunity. Again, I always tell in the webinars and in my conferences, Trump is a blessing in disguise for Latin America, but because he's pushing the region actually to fast track the investments required in infrastructure to actually compete in the global supply chains. So that's why we're seeing investments in Dominican Republic. Kingston is also fast tracking investments to expand the capacity in warehousing, the capacity in the foreign trade zone. So those places are potentially capturing the additional volumes, and that's where I see those new emerging hubs for the region.
Great.
Diego, I only to complement John, I totally agree. What I think it's good for Chancay is that what I mentioned in the presentation is that now we have a direct services, so from China to Chancay. It's totally in line with what you said, and it's more, when do we, something appeared in my computer, sorry. So when do we look for that is not only to become a hub, is not only the inbound, it's also the outbound. Yeah. And they have started with the inbound, facing some challenges, but the outbound is not there yet. Of course, they are developing for that, but we need to give them time to be prepared. One point that I was also in a call yesterday with the managing directors here in Latin America, and we brainstormed on one thing. In some areas in Brazil, the distance by truck from Peru to Brazil can be also a possibility, so it's also, that is not going to, not for a hub, but it could be a possibility to check case by case.
Yeah, no, that's certainly, I think, the long-term plan of Chancay is for it to serve much more than just a Peruvian market. We have an interesting question. What role would logistics providers play in helping businesses navigate geopolitical risk in Latin America? So before I ask you, Vivian, to provide your point of view, certainly, I think Diego would agree with me that of all the work that we do for logistics service providers, as well as logistics-oriented work that we do for industrial companies, there's always an important component around the geopolitical risk, whether it's political risk and regulatory risk in the given market, or whether it's related to trade and how those dynamics change. Inevitably, it's a part of any study that we do on logistics. That's, and even more so when it's cross-border in nature. So certainly that's something that we combine those 2 points of view all the time in that practice. But curious to see, Vivian, one of the amazing things that I came to realize was just how much, and I don't know if this is the case of all logistics providers, but just how much data and analysis that you bring to the table of trade flows, and obviously your intimate knowledge of what's driving that. Is that something that you regularly lend to your customers when dealing with them?
Yes, let's say yes. And we usually, it's different things. So when we think about market update, this kind of market update, normally in the QBRs that we do for our customers, we include market update. And of course, that this market update to the customer is going to focus to their main trade lanes. But we usually participate on that. In terms of research, a lot of market intelligence that we use, like Xeneta, it's one of them. In Brazil, there is a very good one that is Logicomics. We have, that's the world RACD for the air freight. So it's going to be according to the tool and the thing that we want to do the research. And also internally for the customers, when to look data performance, we have a online dashboards that the customer has access, and that to measure all their logistics spends, all their performance, and based on that, normally in the monthlies or in the QBR revision, with the performance, we propose maybe a logistic optimization, consolidate shipment where can be done, or change the route according to the market situation, do this to improve the cost. So this is something that this is a partnership, no? So at the end of the day, we need to work together and put ourselves in our customers' shoes.
Terrific. I don't know if Diego, you wanted to add to that at all?
No, not really.
Okay.
Yeah.
Diego, if you want to take this on, do you expect an increase in the export of agricultural commodities from Brazil to China resulting from the U.S. tariff situation?
That is already taking place.
Yeah.
Yeah, that's already taking place. China has purchased massive amounts of soybean from Brazil. And we didn't mention this in the webinar, but as a result of this trade war, the Brazilian economy is expected to add at least 1 percentage point to its GDP based on these massive agricultural exports. And again, the recent meeting between Lula and President Xi Jinping touched upon a really important aspect for Brazil, which is getting more permits, more ease of doing business to export beef and pork out of Brazil. So what happens in Brazil is that in order for Brazilian beef to reach China, some of these facilities, they need to be approved by the Chinese ministers of health, and all the permits, they need to be approved directly from China. So what happened in this meeting was how we can expedite and facilitate those permits for Brazilian exporters in order to sell more to China. And that's what we're seeing right now. So more sale of beef, soybean, and this is not only Brazil. We will see the same with Argentina. Argentina, despite Milei is looking at the US and Trump as his mantra and his leader, they are also being very smart in selling to China as well. So it's happening all over the place in South America. So this might be a really positive year for commodity exporters in the region.
Yeah. No, it'll be very interesting because, certainly the initial reason for the Chinese to buy these products was that they felt compelled to put huge tariffs on U.S. imports into China, but didn't want to punish their own people by driving up food prices.
Right.
So they shifted to Brazil and Argentina and probably Australia and a few others. But now that the Americans have backed off, at least for 90 days, that's a big look. If we're talking about this on this webinar, we've seen it written about in the press. There's going to be a recognition eventually across the United States that particularly the agriculture sector, which is incredibly politically important in the U.S. because of all those Senate votes that it controls, that they're going to want that market back, right? And they're going to want that. They want to start selling soy again, and meat and chicken and wheat to China, and certainly that's going to be a negotiating piece. So it'll be curious to see if China backpedals on its commitments to not only buying those products from Brazil and Argentina, but also, like you said, investing in port infrastructure, in container terminals, in refrigeration capacity, et cetera, to move more of those food products out of Mercosur into China. So that'll be very interesting.
My take is China won't backpedal on that because they want to get rid of the US leverage on the negotiation. If they know that they have access to Brazil agricultural products, they have access to infrastructure, and they have access to low prices, there's no more leverage on the US side. So they get more leverage. And when you
Right.
think about the situation between China and the US in the recent negotiations in Switzerland, China got everything that they wanted. The US dropped its 145% reciprocal tariff to 10%. And then China matched the same 10% reciprocal tariff. And then the US kept its 20% on the fentanyl border crisis. But China got everything they wanted because let's remember, they were asking to Trump, okay, we can sit down if you guys remove your reciprocal tariffs. And Trump was saying, no, I'm not going to do that. What happened? They removed the reciprocal tariffs. So China
Right.
has a little bit more leverage now.
Right. I have an interesting question from Michelle Perez. Considering the recent increase in ocean freight rates from China, the reduction of tariffs between China and US, and the cancellation of some services to Mexican ports, what impact do you foresee on freight levels into Mexico in the short to medium term? Do you expect a shift in import patterns or additional pressure on available capacity?
Yeah. When do we see this current situation in Mexico, where Mexico is the drive for the West Coast, South America, and the retailers with this peak season that is expected from the traditional peak season for the retailers, July to September, the rate is going to increase for sure. And especially if some capacity is taken over to cover the US. So we started already to receive information that the rate is going to increase. Not sure yet how much, but what we foresee is at least the next, from June to September, rates in a high level.
Okay, terrific. We have a question from David Schoeneberger, who I had the pleasure of meeting yesterday. David, you asked about, given the cost cutting going on in Washington, will there be a reduction in support for DFC, which used to be known as OPIC, IFC, and other US government support for business development in Latin America? It's tough to say which programs may be affected or others, but certainly I think the Department of Commerce remains a very strong department under its leader, who's been, a very close ally of Trump, sort of in the inner circle. So he's going to want to defend as many tools that he has at his disposal. So I think as long as he has a say, those programs will remain in place. I can't speak to those that fall outside of his auspices, but that's a somewhat speculative answer, but I think seems to square off in terms of what I've seen so far. Let's see. I think, some of these are truly speculative, like trying to imagine a world 6 months from now when will Trump back off from its from even the baseline 10% tariffs. I think it's really difficult thing to speculate about. I think that the US wants to maintain 10% across the board.
Yeah.
They may take that away in case they negotiate free, radically improved trade agreements with countries where they felt they lacked market access. But other than that, and other than existing trade agreements that are considered exempt from that, I think we will see that as a baseline. That's at least what Washington's saying pretty consistently. I don't know if you agree, Diego.
I agree with you. The 10% tax is going to stay here. And the best example is the US-UK trade deal that they announced last week. So that remain in place. But again, substantial changes in those trade deals. We haven't seen much. However, key points when you think about the countries in which we're focusing these trade deals, South Korea, Japan, India, Argentina is first in the row here in South America. So 10% probably will stay, even though that the US won't cover the tax cuts that the Republican Party is pushing through Congress. The 10% will help generating some revenue for these tariffs. So that's one of the key scenarios that we see. The 10% remains. Second one, I'm really bullish when it comes to the USMCA renewal. We might get that by before the end of 2025, early 2026. That's something very likely. And the third scenario that I see in 6 months is we may get a permanent, let's say 25-30% tariffs on China, and that starts to create a shift again back to production in Mexico, but not from Chinese companies, but from actual American companies. And we may see some European companies actually moving to Mexico because of that. So in short, what I expect to see in the next 6 months is high levels of tariffs with China, 10% tariffs across everyone, and we may see more and more intra-regional trade in Latin America as a result of that. So I'm very positive on the expectation of what we may see in the next months.
Okay, well, on that positive note, I want to recognize that we're 30 minutes beyond our original deadline. I want to thank everyone who stayed online, who gave us some really wonderful questions to answer. And certainly I want to thank both Diego and Vivian for joining me in this fascinating discussion. We may have to repeat this in 6 months, given the pace of change, and see if any of our foresight proved true. Awfully difficult to forecast with any degree of accuracy how Washington will behave on these issues, let alone how the rest of the world will respond. So this remains a very dynamic space, but I think people are warming to the idea that they have to keep pressing forward, be more agile than in the past. But I think paralysis of business and business decisions is the worst enemy of operating in a situation like this. And so I think companies are coming to terms with the fact that they need to reduce their annual planning to quarterly planning, that they need to make decisions more readily, that they need to constantly inform themselves to make those decisions, whether it's up-to-date competitive intelligence, whether it's up-to-date regulatory analysis. Those are the kinds of levels of information that we provide, that your freight forwarders who are well informed like Vivian can provide. So please lean on firms like AMI, JAS to help inform those decisions going forward. That's what we're here for, and we look forward to hearing from you. Thanks, everyone.